Hey everyone, and welcome to today's Explainer. Today, we're jumping right into something I find absolutely fascinating, the absolute nuts and bolts of business partnerships and accounting. Have you ever wondered how multiple people can legally team up, pool all their resources, and figure out exactly who gets what at the end of the day without ending up in a massive fight? Well, you are in the exact right place. We're going to break down the rules, the math, and the underlying logic that dictate how partnerships actually operate in the real world. So let me kick things off by asking you this. Can you really build a successful business entirely solo? Imagine for a second that you've got 5 lakh rupees sitting in your bank account, just waiting to be invested. But you have zero free time to run a day-to-day operation, and honestly, you don't have the specific technical skills to make a product that people actually want to buy. You know, you could try to wing it all by yourself, but it would be a total uphill battle. This roadblock is exactly where the power of partnership comes into play. This is where teaming up completely changes the game. Let's look at Chintu, Chinti, and Bunty. Chintu is our investor. He's got the 5 lakhs, but no time. Chinti is an absolutely phenomenal baker with these killer recipes, but she's totally broke. And Bunty? He's a marketing wizard who knows exactly how to make a brand go viral online. On their own, they're kind of stuck, right? But together, boom, they launch a powerhouse bakery called The Better Basket. They're pulling their distinct superpowers to build something they literally couldn't create alone. All right, here is our roadmap for today's Explainer. 1. What is a partnership? 2. Essential features of a partnership. 3. The partnership deed. 4. Rules when no deed exists. 5. P&L appropriation account. And finally, 6. Partners' capital accounts. Let's dive in. Section 1. What is a partnership? Let's lay down the legal foundation for teaming up.
Because it's not just about hanging out and selling cupcakes, right? The crucial legal definition is found in Section 4 of the Indian Partnership Act of 1932. It sounds a bit formal, a relationship between persons who agree to share profits, but look closely at that last phrase, carried on by all or any of them acting for all. That's the real magic right there. It means all 3 of our bakery founders could be working the counter, or maybe just Chinti is in the back baking on behalf of the whole crew. Either way, they share the rewards, and they definitely share the risks.
Moving right along to Section 2, the essential features of a partnership, which are basically the 5 pillars of teamwork. But before we hit those pillars, we got to talk about the legal limits. Obviously, you need at least 2 people to start a partnership, but is there a ceiling? Actually, yes. Rule 10 of the Companies Act draws a hard line at a maximum of 50 partners. If you want to bring in a 51st person, you can't be a partnership anymore. You are legally forced to transition into a full-fledged company. So, 2 to 50 is your sweet spot. Now, those 5 essential pillars. You need 2 or more people, an agreement, which can actually just be an oral agreement, surprisingly, a lawful business, and the sharing of profits. But I really want to pause and land heavily on pillar number 5, mutual agency. This is a huge deal. It means every partner is an agent and a principal for the business. So if Bunky makes some wild guarantee to a customer, guess what? Chintu and Chinti are legally bound by that promise, even if they were miles away. You act for each other. Okay, Section 3, the partnership deed. It's time to write the rules down. But wait, what if our baking trio is just so hyped to start selling that they shake hands and totally skip the paperwork? Fast forward 6 months. Chinti is pulling 12-hour shifts in a hot kitchen and starts demanding a salary from Chintu. If they never took the time to create a formal, written partnership deed to settle this exact kind of dispute, what on earth are they due? That brings us right to Section 4, rules when no deed exists. The default laws of 1932 step in when you fail to plan. And let me tell you, these default legal rules are incredibly strict. Without a written deed, profits are split perfectly equally. Period. It does not matter if Chintu put in all the cash and Chinti does literally all the physical work. Equal means equal. Also, nobody gets a salary, nobody gets a commission. If a partner happens to give a loan to the business, they get exactly 6% interest per year. No more, no less. And if you want to bring in a new partner, you need 100% unanimous consent. 1 no vote out of 49 partners, and the deal's dead. Let's transition to Section 5, the P&L appropriation account. This is where we face the accounting reality of dividing up the cash. To really grasp how the math works here, you have to split things into 2 distinct buckets. First, you have a charge against profits. These are the non-negotiable bills, things like rent or employee wages. You absolutely have to pay these, even if your business is bleeding money. The other bucket is called appropriation of profits. This is the fun part. This is how you chop up and distribute whatever cash is actually left over as profit shares or partner salaries. So how do you remember what falls into that mandatory charge bucket? Let's use a super handy memory trick. The RIM mnemonic. R-I-M. Rent, interest on loan, and manager's commission. RIM. Those three items are compulsory charges. You have to subtract them out first before you can even dream about calculating the partner's final cut.
Let's look at a really quick example to make this concrete. Say the firm profits 50,600 rupees. But wait, partner A gave a loan, and remember that default rule? Without a deed, they get 6% interest. Let's assume that calculates out to 600 rupees. Because loan interest is a compulsory charge, the I and RIM, we deduct that 600 right off the top. That leaves us with a clean 50,000 rupees. And because there's no deed, we distribute that remaining cash equally. Partner A gets 25,000, partner B gets 25,000. It's totally clean, completely fair, and legally ironclad.
Finally, Section 6, Partners' Capital Accounts. We've got the profits, but now we need to track the wealth. So where does that 25,000 rupees actually go? You've basically got two choices here. If a firm uses the fixed capital method, they literally run two accounts per partner, one for their permanent initial investment and a separate current account for the daily chaos of profits, salaries, and withdrawals. But if they go with the fluctuating capital method, it's way simpler. Everything, the original investment, the new profits, the whole shebang, just gets dumped into one single capital account for each partner.
Okay, let's bring this whole thing full circle. Think back to Chinty, sweating over the ovens all day, while Chintu is chilling at home. If she's running the entire show, but they never quite got around to signing a written partnership deed, can she legally demand a salary at the end of the year? Well, based on everything we just covered, the answer is a hard absolute no. Without a deed, the default laws take over, salaries vanish, and everything is just split right down the middle. Which kind of makes you wonder, if you were starting a business with your friends tomorrow, what uncomfortable conversations are you avoiding right now that you desperately need to put in writing? Thank you so much for joining me on today's Explainer, and I'll let you chew on that one.